Welcome, my friend, to part 2 of trading stock market cycles. Today we're going to talk a little bit about day trading, but a lot of what I'll share is going to be applicable to swing trading as well. And it also applies for stocks, forex, futures, commodities. But I'm going to give you an example at the end that is specifically for day trading. By the way, if you missed part 1, then you can watch this first. Part 1 is not necessary to watch before this part 2. But go ahead and after you're done with this, type in Trading Stock Market Cycles Part 1, TopDogTrading into the search bar of YouTube, and you will find it. All right, so last time we talked about seasonal or calendar cycles, agricultural seasons, retail seasons, travel, etc. Today we're talking about a very different type of cycle. This one is volatility. So what do I mean by volatility cycles? Well, I call these trades, this family of trades, ex-con trades. And what that stands for is expansion, contraction. So volatility has to do with the range of the market within a period of time. How much does price cover with regard to the expansion of the movement of prices from highs to low and lows to highs? And then we get into narrow range markets, and that's when we have contraction. And that's actually a cycle in the market. So you will see markets that are sometimes very high volatility, and they make these big, huge swings, and people think, oh, that's really exciting, I want to get into that market. And then other times people see markets that are in very narrow range, and they'll say, oh, I don't want to get into that. Okay, there's some truth to that, but it is a little trickier than is at first glance. So I want to share with you how I trade this and see if it makes sense to you. Because most people, in my opinion, trade this backwards. And I've done very, very well with this type of trading, by the way. So speaking not only from experience, but from success. So here's how I see most people doing this. They will scan for high volatility markets to trade. And so it kind of makes sense, right? There's a logic to that. They say, hey, I want to get into a market that is really moving. And a lot of times the thinking of that is that there's certain stocks or forex pairs or futures, commodities, whatever, that are high volatility markets. And they leave it at that, as though it's always a high volatility market. A market that's always tending to move and make big swings. And of course, they want to get on that so that they can make some big profits quickly. Problem is, they don't realize that this is a cycle that pretty much every market goes through. So some markets will, let's say there's a particular stock that has high volatility. Well, it's not that it's always high volatility. It'll go through a period of really moving. And then all of a sudden, it starts to slow down and contract. We've actually seen that in some cryptocurrencies recently, where everybody gets all excited to say, oh man, this market's crazy and it's high volatility. Well, it was high volatility. And now that the CME and SIBO have come on board, now it started to contract a bit again. So there you go. Okay, you don't want to chase the high volatility is one of the ways of saying this. So in practical terms, one of the mistakes people do is they will use a scanner and scan for high volatility markets to trade. The problem is that by the time a scanner accumulates enough data for it to then show up and mathematically trigger as a high volatility market, then it could be very close to the time, the period, or that cycle of it being high volatility to end. In the next cycle of low volatility or contraction to kick in. And then they wonder, hey, dang it, how come every time I get into these markets they really move, and then when I get in, all of a sudden, then they go into a narrow range. And they think, oh, my broker's trading against me, the market makers, they got it out for me. No, it's just that they haven't been taught about the ex-con cycle, expansion contraction cycle. So they're always trading the wrong end of it, and especially because, as I said, mathematically, the scanners need a certain amount of time, a certain number of data to accumulate in order to mathematically then indicate that, yeah, this is a high volatility market. So they always get in at the wrong time. Sound familiar? So what I like to do is exactly the opposite. And just like most things in trading, the opposite usually works. So if you've ever felt like, dang, I'm a perfectly imperfect trader. If I just did the opposite of everything I did, I'd probably make some money. Well, you know what? Probably not far from the truth, because trading actually is very counterintuitive. And so what I do is I trade inside contraction. I actually scan for contraction markets. Now, what does that look like? Well, again, this is not completely new. There's other people who do this as well, and you've heard of these types of patterns, such as triangles. That's really my favorite. I love trading triangles. In fact, if you want to learn exactly how I trade triangles and trade inside the triangle, I have another video specifically on that technique. Just type in TopDogTrading and triangles, and you'll probably find it. But I don't wait for the breakout of the triangle. Some people wait for the breakout of the triangle. Some wait for the breakout and then the throwback or the retrace before they get in. I don't wait for any of that. I trade while it's inside the triangle before the breakout. So I'm entering inside of contraction. Another example would be Bollinger Band squeezes. They can be really great. I like those. Wedges, very similar to triangles, and etc. So you get the idea. These are patterns that are very well known, but timing, when to get into these, is the key. And speaking of timing, by the way, I do have a tremendous timing indicator. Be happy to give it to you absolutely free, since you're one of my YouTube subscribers, or even if you're not a subscriber, although I encourage you to subscribe. But hey, you're watching this, be happy to give it to you. Just send an email over to me at barry@topdogtrading.com, and we'll show you how to get that absolutely free. And that will really help you with your timing. I find this is one of the things that people neglect. They understand price levels, support resistance pretty darn well, and that's great. But there's another side of the chart, not just the y-axis, that's price, but then there's the x-axis, and that is time. That's 50% of the chart. You better know how to time your entries with precision, and that's what this indicator will help you do. I promised to give you a day trading setup here, and so that's what this is. So this is a typical pattern, a meta pattern, as I like to call it, in day trading, and you're probably familiar with it. We're in the morning. We have high volatility. The market moves most of the time in the morning between the open of the market and lunch. And then during lunchtime, the market quiets down, goes into a bit of consolidation, and the swings between the highs and lows gets more narrow range. And then in the afternoon, it breaks out again, and we get some good volatility going, get some big moves. So not every day is like this. This is, again, a meta pattern. It is not an everyday pattern. So this won't happen every day, but it gives you something to look for. So one of the trades that I look for example, is to trade at the end of lunchtime. So I am watching and saying, okay, let's find out a time to trade this inside of lunchtime, but toward the end of lunchtime. And I got to tell you a little secret here. Sometimes back when I was trained in Chicago at the Chicago Mercantile Exchange, we would watch the whales. And because everybody knew this meta pattern, again, this is the problem, right? Once everybody gets to know something, then it stops working. Well, it's not that it stops working all the time, but again, everyone knows this. And so the big money, they don't want to be followed. And so what a lot of these guys would do is they would turn the accounts over to their fledglings, and they would just basically say, do no harm while I'm gone. And they'd leave the building, or they'd leave the room, I should say. They'd be gone maybe a little bit, and then they'd come back in. They didn't actually go to lunch. They left the room, and came back in because they wanted everyone to think they left. And then they would take a trade during lunchtime, and a big one. I find that these happen about once a week on average, sometimes twice. But this is another one that you can look for. Again, you're going to have to be patient because it's not going to happen every day. It's not meant to be easy. Nothing in trading is meant to be easy. In fact, if you feel like the market's against you, you are 100% correct. Because the other people in the market, especially the professionals, they are not there to give you money. They are there to take your money. So yeah, they make it as difficult as possible. They always try to hide their tracks. They know these common things that people are looking for, and they do intentionally try to throw you off of their tails. So yep, but there you go. So the patient one is the one who wins. In fact, I've often said that professional traders outpatient amateur traders. So these little anomalies, it's not even an anomaly because it does happen pretty much every week, once a week, sometimes twice a week. And when it doesn't, then you just wait till toward the end of lunch and take the trade into the afternoon. But if you wait for the breakout in the afternoon and you wait for it to break out, usually you're giving up too much money. The reward is pretty much going to be gone by the time you see it again measured and you can confirm it. And so that's too late. Professionals are early and retailers are always late. So you've got to be early. And this is why you need to read charts. This is why you need to learn how to read the details, the inner details. I always say that the dollars are in the details because every day it's going to be a little different. Again, market's not here to make it easy for you. So you've got to read it day by day, bar by bar, because each day is going to be different. Each little pattern every hour is going to be different. And yeah, that's very intentional. So if you like this video, please understand that sure, it's free, but if you got value from it, you actually have now a moral obligation to pay it forward to others, not to me, but to others, by clicking on that beautiful little share button below so that others can benefit from it as well. And as I mentioned, please subscribe to the videos because that way you'll get notified every time I come up with a new tutorial, which is every week. Click the thumbs up icon and leave a comment. I love your comments. That really lets me know you're engaged. And well, frankly, it encourages me to create more free tutorials for you. As a special offer to you, my YouTube viewers, I'm giving you one of my favorite trade strategies. This is what I call the rubber band trade strategy, which has a very, very high win-loss ratio. Now, in this trade strategy, I get into the details of exactly where I enter, exactly where I place my stops, and exactly where I get out. And it is part of one of my courses, but I'm going to give it to you for free in a 26-minute video. You can get that rubber band trade strategy absolutely free by clicking on that image in the top right corner of the video or in the description below. And if you're not watching on YouTube, there's probably a link below or an opt-in form on the side. Once you do that, I will personally email the video to you with the rubber band trade strategy.